Let's review the structure of a balance sheet. On the left we put assets, on the right we put liabilities and equity. Assets is how much all a firm's assets are worth in dollar amount. Liabilities, how much we owe, how much debt we have, and equity is the same thing as net worth. So think about a firm, let's say, shutting down. If it sells everything that's under its assets, makes money, right? And then if it uses the money to pay back everything that it owes, then how much would be left? That's the net worth. The balance sheet identity is this little formula that says what's on the left side, assets, equals everything that's on the right side, liabilities plus equity. Now let's look in more detail at what's under assets, what's under liabilities, and what's under equity. Assets are first. We can categorize assets into current assets and fixed assets. Current assets include items like cash, inventory, and accounts receivable. And fixed assets include everything else. It includes, kind of think of much bigger assets. Tangible, that could be touched, like buildings, computers, equipment, trucks, and so on. And intangible, things that have value but cannot be like touched with your hands, right? Like patents, like software. Another way to think of what makes certain assets current assets and others fixed assets is think about how long it may take to convert them into cash, to sell them, in other words. So current assets are cash and things that could be converted into cash within 1 year, so a relatively short amount of time. For fixed assets, the amount of time it would take to convert those assets into cash would be significantly longer. For example, it typically takes many months, it could be many years, or at least a few years to sell a building. So this is sort of a convention in finance. Short-term versus long-term. Short-term, we assume it's anything that can be turned into cash within a year. In this sample balance sheet here, we actually have, in a way, two balance sheets. One for 2011 and one for 2012. So current assets and fixed assets are on the left-hand side, and notice how current assets are first, followed by fixed assets on the bottom, underneath. And it's actually going to be the same structure when we then look at liabilities and equity. We will have current liabilities first and then sort of longer-term liabilities underneath. Now let's actually talk about liabilities, and on the following slides we will look at equity. Liability is the same thing as debt, how much we borrowed that we still need to pay back. So the money that we owe to our creditors. And just like with assets, liabilities can be called current and long-term. Current is what we basically need to pay off within a year. So it's the same sort of time period that we used for current assets on the earlier slides. And under current liabilities, we have accounts payable. So that's what we owe to suppliers from whom we purchased our supplies on credit. So we already have the supplies in our hands, but we have not paid the cash yet. There is a time delay. And so for that time period, the amount that we owe will be put under accounts payable. Notes payable is basically short-term loans. And long-term liabilities include long-term debt. By the way, this is where bonds belong. If a company sells bonds as a way to borrow money, they would appear under long-term liabilities. And in this sample balance sheet, current liabilities appear first on the right-hand side, and then they are followed by long-term debt underneath. In finance, we use the term leverage or financial leverage a lot. This should be interpreted as using debt or having debt, having money that's borrowed that needs to be paid back. And so a firm is called levered if it has debt in its capital structure, regardless of how much. It can be a lot of money that's borrowed or a little bit of money that's borrowed. All such firms would be called levered. But a firm with more debt would be called a firm using a higher financial leverage. An unlevered firm is that firm that has no debt at all in its capital structure. Then this little picture here shows kind of something from physics, where you push on this longer end of the surface just a little bit, and it pushes up the other shorter end by a lot. So that's actually where the term leverage is coming from. It's coming from physics, and this is actually beyond the scope of this class, just to explain. But turns out that a firm can borrow just a little bit to see a huge increase in profits. So this is where the word leverage is coming from, but all you need to know from this slide is the word leverage refers to using debt. That's it. And finally, let's review the part of a balance sheet called equity, bottom right. Same thing as net worth. So equity has different terms. You can also say shareholders' equity or stockholders' equity or common equity or owner's equity. It's all one and the same thing. Now there are two components. One is typically called common stock and paid-in surplus. So that's the dollar value of all shares when they were first sold. So let's say 1,000 shares are sold for $100 each. Then this part in the balance sheet is going to have $100,000 in it. The second component of equity is called retained earnings. So this is basically additional money that's added with each year. That's nothing but how much profit from the annual production and sales is kept or retained by the firm. So profits could be distributed as dividends to the stockholders, or maybe some are distributed and some are retained, or maybe all of profits are retained. So the amount that is retained every year is added to the firm's equity into the balance sheet. And again, our sample balance sheet shows the two components of equity in bottom right of this balance sheet.